June kicks off on, well, I'm saying a downbeat note following May's gains. At least we haven't really gotten out of the starting gates. And there's plenty on the calendar this month to keep investors busy. There's a jobs report this Friday. There's the FOMC meeting. And, of course, there's Britain's exit from the EU vote on June the 23rd. Let's bring in Matson Money CEO Mark Matson. All sorts of things going on in June. What are you expecting, Mark? It's been a lot of people have said this market is overpriced, a little frothy, if you want to use that term. What are your thoughts?
Well, I'm always excited about the market because I understand basic math. Long term, even since going back all the way to 1926, major depressions, equities have averaged on average 10% a year. Now, obviously, you're not going to get that every year, and no one has a crystal ball about what's going to happen in the next 12 months. But long-term, investors are rewarded for that type of risk. And I hear people saying June gloom and Zoom doom. But, hey, you might as well call it June Zoom because, on average, equities are up 0.91% in June since 1926. So look long-term and stop trying to predict the next 10 minutes is what I tell investors.
Yeah, but there's a lot of nervousness out there. I get the sense that the markets have already factored in a Fed rate hike in the summer. Would you agree?
Markets are amazingly apropos at pricing in expected new events. As a matter of fact, it's only unpredictable or new events that change the prices. But I think, to your point, everyone's very negative right now. But there's a lot of potentially good things in the future. On our academic board, Art Laffer is now talking to Donald Trump about trying to engineer a Reagan-esque recovery with lower taxes, more innovation, less regulation. And if you were falling back to Reagan, his second year in office, there was a 10% 10% growth rate for the United States. So, you know, don't count the United States out of the growth of the future.
All right, let's get down to some of the individual stocks. You like Samsung, part of the emerging markets portfolio. Why Samsung, Mark?
Well, I like any stock that has a high book-to-market value. So Samsung's a good example of a company that has a lot of assets but a depressed price. And on average, those types of companies have about a 3 to 4% higher expected return. But I don't want an investor to get too in love with any one stock because we have over 12,000 equities in 45 different countries. So that's a good example, but don't bet the farm on one company.
What about Wendy's? Why do you like Wendy's?
Well, Wendy's is the exact same thing here in the United States. They have, in addition to the fact that they say they have better burgers, they're actually a depressed company. They haven't stayed up with the times. Their marketing has actually gone down. Most people stay away from those companies, but those companies have a higher cost of capital. So long term, they're small and depressed, higher long-term expected returns to investors.
All right, and then lastly, if I'm reading it right, Netgear. You like this as well. Why? Very quickly.
It's an example of a very small, depressed company, and it has a high book-to-market value. You have to be in all the different sectors. This is a technology company. A lot of people are out of technology. Own them all.
Mark Matson, you did great. Thank you so much.